In September 2008, a single investment bank collapsed. It was a name synonymous with Wall Street, a giant of finance. And within just a few weeks, its downfall sent shockwaves that crippled the entire global economy. This is the story of how one company, Lehman Brothers, triggered a worldwide financial meltdown. To understand the magnitude of Lehman's collapse, you first have to understand what Lehman was. It wasn't just another bank. It was a true Wall Street institution, a titan that had stood for over 150 years. Think about that. Lehman Brothers survived the American Civil War, the Great Depression, 2 world wars, and countless market crashes. This wasn't some fly-by-night operation. They were financial royalty. They advised governments. They financed the corporations that built the modern world. And they were at the very heart of shaping modern finance as we know it. Inside the walls of Lehman, there was a deeply ingrained belief, a sense of invincibility. They were too old, too smart, and too experienced to fail. This hubris, this unwavering confidence in their own legacy would become their fatal flaw. The seeds of destruction were sown in the early 2000s during a period of seemingly endless prosperity. Lehman Brothers, like many on Wall Street, saw an incredible opportunity in the booming U.S. housing market. They made a massive, aggressive pivot into real estate, specifically into something called mortgage-backed securities. Now, these were complex financial instruments, essentially bundles of thousands of home loans packaged together and sold to investors. They promised incredibly high returns, and for a while, they delivered. The risk, however, was cleverly hidden behind layers of complexity. The entire model was built on one simple, dangerous assumption, that housing prices would always go up. As long as home values were rising, people would make their mortgage payments, and the securities would generate massive profits. To amplify these profits, Lehman took on staggering amounts of debt. This is called leverage. For every dollar of their own money, they were borrowing $30 or even $40 to invest. It was a high-stakes gamble. More debt meant more profit, and the money rolled in. It was the risk that paid far too well until the day it didn't. By 2006, the first cracks in the foundation began to appear. The seemingly unstoppable housing market started to cool down. Demand for new homes slowed. And more importantly, people started defaulting on their mortgages, especially those with subprime loans. As defaults rose, the value of those mortgage-backed securities began to plummet. Liquidity, the lifeblood of any bank, started to tighten. It became harder to sell these assets and harder to borrow money. Inside Lehman Brothers, alarms were being raised. Analysts and risk managers saw the writing on the wall. They warned senior leadership that the firm was dangerously exposed. But admitting the problem was a difficult pill to swallow. Pulling back would mean taking huge losses and admitting to the world that their golden goose was cooked. So the leadership chose a different path. They chose optimism over caution. They doubled down, insisting the market was just experiencing a temporary dip and that everything would soon recover. They hid the extent of their toxic assets and continued to project an image of strength and stability, all while the ground was crumbling beneath their feet. The terrifying truth was that Lehman Brothers wasn't an island. The risk wasn't contained within their headquarters. The entire global financial system was interconnected in a way that few truly understood. Banks all across the world, from London to Tokyo, were holding the exact same types of toxic mortgage-backed assets. They had all bought into the same promise of high returns. This meant that if Lehman went down, it wouldn't just be one bank's problem. It had the potential to start a domino effect, a chain reaction that could freeze the entire system. A single bank failure threatened to become a full-blown systemic crisis. As Lehman's situation grew more desperate in early September 2008, regulators and government officials faced an impossible choice. Saving Lehman with a government bailout might prevent immediate chaos, but it would also create what's known as moral hazard. It would send a message to every other bank that they could take reckless risks and the government would always be there to rescue them. On the other hand, letting Lehman fail meant unleashing an unknown level of chaos onto the world. For one critical weekend, the fate of the global economy hung in the balance. The decision came on Monday, September 15, 2008. There would be no bailout, no last-minute rescue. Lehman Brothers, the 158-year-old titan of Wall Street, filed for the largest bankruptcy in U.S. history. The immediate effect was pure shock and panic. The markets froze. The Dow Jones Industrial Average plummeted. But the most critical impact was the complete and utter evaporation of trust. Banks, which lend money to each other every single day to keep the gears of the economy turning, stopped trusting each other overnight. No one knew who else was holding the same toxic assets that brought down Lehman. The credit markets, the circulatory system of the global economy, seized up entirely. The impossible had happened. A giant had been allowed to fall, and now everyone was bracing for the consequences. The collapse of Lehman Brothers was not a localized event. It was the trigger for a global financial earthquake. The shockwaves spread with terrifying speed. Stock markets around the world crashed, wiping out trillions of dollars in wealth. In the weeks that followed, other major banks and financial institutions either failed or were forced into emergency government bailouts. AIG, the world's largest insurer, had to be rescued. Washington Mutual collapsed. Governments were forced to inject hundreds of billions of dollars into the banking system just to prevent a total meltdown. The crisis quickly spilled from Wall Street to Main Street. Businesses couldn't get loans, leading to massive layoffs. Unemployment skyrocketed. The world plunged into the most severe recession since the Great Depression. What began as a problem with American mortgages became a crisis that affected jobs, savings, and lives in every corner of the globe. The name Lehman Brothers became a powerful, enduring symbol of systemic failure and the dangers of unchecked greed. In the aftermath of the chaos, the world scrambled to make sure this could never happen again. A wave of new regulations was introduced. Laws like the Dodd-Frank Act in the United States aimed to increase oversight and transparency in the financial industry. Banks were forced to reduce their leverage and hold more capital in reserve to absorb potential losses. Stress tests became a regular occurrence to ensure banks could survive a future crisis. The goal was to make the system safer, less complex, and more resilient. But the damage was already done. The crisis left deep, lasting scars. Millions of people lost their homes, their jobs, and their life savings. And perhaps most significantly, trust in the very institutions that are meant to be the bedrock of our economy was permanently shaken. The belief that our financial leaders knew what they were doing was shattered. When we look back, it's clear that Lehman Brothers didn't collapse in a vacuum. Its failure was a symptom of a much larger disease. It exposed a global financial system that had been built on a fragile foundation of overconfidence, dangerous complexity, and unchecked risk. The story of Lehman is a timeless lesson. In finance, as in life, confidence is everything. But when that confidence is misplaced, when it becomes blind arrogance, the fall is inevitable. And when it finally disappears, everything else follows. Thanks for watching. If you found this story insightful, be sure to subscribe for more deep dives into the events that shaped our world.